Navigating a recession, understanding economic implications and mitigation strategies. An economic recession is a prolonged period of time in which a country's or region's economy experiences a decrease in its economic activity, such as a decrease in GDP, employment, and income. It is often characterized by an increase in the unemployment rate and a decrease in investment and consumption levels. There are several causes that can contribute to an economic recession. One of the main causes is a financial crisis, such as the one that occurred in 2008, when the U.S. housing market collapsed and caused a crisis in the global financial system. This led to a decrease in credit levels and increased loan costs, which in turn reduced consumption and investment. Another common cause of an economic recession is an increase in the cost of production factors, such as oil or gas. This can increase production costs and reduce the profits of companies, which in turn reduces investment and employment levels. In addition, inadequate economic policy, such as an interest rate hike or an austerity fiscal policy, can also contribute to an economic recession. In terms of its impact, economic recessions can have a devastating effect on people and businesses. Unemployment increases, incomes decrease, and businesses may close. There may also be an increase in debt levels and a decrease in consumer confidence. It is important to note that recessions are not isolated to one country or region. They often are a global phenomenon and can have a significant impact on the world economy. In summary, an economic recession is a prolonged period of decreased economic growth, characterized by an increase in unemployment and a decrease in consumption and investment levels. It can be caused by a number of factors, including financial crises, increases in production costs, and inadequate economic policies. The impact of a recession can be devastating for individuals and businesses, as it can cause an increase in unemployment, a drop in income, a decrease in the value of investments, and a reduction in consumption. However, it is important to remember that recessions are a natural part of the economic cycle. The combination of war, a pandemic, and excessive debt in the global economy could have devastating consequences for the world economy. Firstly, war can disrupt production and trade, which in turn can reduce GDP and increase unemployment. Additionally, wars often result in an increase in the costs of production factors, such as oil, which can have an inflationary effect and increase the prices of goods and services. The pandemic also has a negative impact on the economy, as it can disrupt production and trade and increase unemployment. There may also be a decrease in consumption due to economic uncertainty and a reduction in people's incomes. Finally, excessive debt can have a negative impact on the global economy, as it can make it difficult to access credit and increase the cost of loans, which in turn can reduce investment and consumption. There may also be an increase in the risk of debt default, which can lead to a financial crisis. The combination of these three factors could have a devastating impact on the world economy, resulting in a prolonged economic recession and a significant increase in unemployment and poverty. Additionally, this could result in an increase in debt levels and a decrease in the confidence of investors and consumers, which could have a negative effect on the economy in the long term. It is important to note that a global economic recession could have a significant impact on the world economy and people's lives. Therefore, it is important to take measures to prevent and mitigate the effects of an economic recession, through adequate fiscal and monetary policies and strict financial regulation. The Federal Reserve, Fed, and other central banks have several tools they can use to mitigate the effects of an economic recession. Some of the most common measures include interest rate reduction. The Fed can reduce interest rates to stimulate economic growth. This makes it cheaper for businesses and individuals to get loans, which can increase investment and consumption. Quantitative easing. The Fed can purchase government bonds and other securities to increase the money supply, lower interest rates, and stimulate economic growth. Liquidity provision. Central banks can provide liquidity to the financial system to ensure stability and prevent a financial crisis. Communication. Central banks can also use communication to influence market expectations and policy decisions. However, it is important to note that any of these measures have their own risks and disadvantages, and that a poor implementation can have negative consequences. For example, excessive reduction of interest rates can generate a speculative bubble, and expansive monetary policy can generate uncontrolled inflation. In addition, expansive fiscal policy can generate an increase in government debt and an increase in financing costs. In summary, the Fed and central banks have several tools at their disposal to mitigate the effects of an economic recession, but it is important that they be used carefully and strategically to avoid negative consequences on the economy. The appropriate investment strategy will depend on each investor's individual goals and risk tolerance. However, some general recommendations that investors could consider in a scenario of high inflation and an economic recession include: diversifying the portfolio. It is important to have a diversified portfolio to reduce risk. This could include investments in different classes of assets, such as stocks, bonds, real estate, gold, etc. Investing in defensive assets. Assets considered defensive, such as treasury bonds, stocks of utility companies and basic goods, can be less affected by the economic recession and high inflation. Investing in assets that benefit from inflation. Assets that benefit from inflation, such as gold or commodities, can be a good option as they typically have an intrinsic value that stays the same or increases with inflation. Investing in stocks of companies with a solid cash flow. Companies with a solid cash flow are better able to cope with economic difficulties and may be less affected by the recession. Considering investment in emerging markets. Emerging markets can provide attractive investment opportunities in a global recession environment, as these markets may have a higher rate of economic growth. It's important to note that no investment strategy is foolproof, and past performance does not guarantee future performance. Therefore, investors should do their own research and consider their investment goals and risk profile before making any investment decisions. Additionally, it's advisable to stay informed and be aware of economic and political news that can affect their portfolio and be ready to adapt to changing situations.